Welcome to Real Turkey channel. This is your loving, caring presenter Atilla Yeşilada. As you see, we make new changes and improvements in each broadcast. This time we have completely dispelled with production quality. You see the extremely romantic background with almost no lighting and a table full of medicines and food because I am abroad trying to cure my lungs, which have been deeply hurt by my 50 years long cigarette habit. Okay, so much for the intro. Let's immediately cut to the chase. I've been remiss in terms of broadcasting this video because I've tried to find English graphics, which you will see in the course of this video. We're talking about the Turkish economy. There has been several changes since my last broadcast, and I found the title, just an old title, a cliche title, The Good, the Bad, and the Ugly Appropriate. Mr. Clint Eastwood, please don't shoot me, even though I'm a punk. Let's start with the good. The production side seems to be improving. We measure the most up-to-date production developments from PMI indices, of course. Turkey has two PMI indices, one of which is by Istanbul Chamber of Industry in association with Market, which compiles PMI all over the world. That has soared to over 51, and this is the second time it has been over 50. That is the expansion territory over the last 25 months. So we conclude Turkey's manufacturing industry, which has long been depressed, has finally came alive. The second one is compiled by Müsiad, a business association. It's called SUMEX. And in my view, it's a much better indicator of the whole economy because it's a composite PMI encompassing services as well. That too is in excess of 51, even though it has declined on a month-on-month basis, and services do show a weakness, registering a headline number only of 50.2. Nevertheless, it's very clear that the production side, the industry side is doing fairly well. We also see that from the sectoral confidence indices, such as the retail, confidence index, the real sector confidence index. The businesses have regained some hope that orders and sales will improve within the next 3 months. That's the good news. We may add to that some improvement in the consumer confidence data in the sense that it stopped declining. It's still below 100. As you know, 100 is the cutting line. Consumers are still in the pessimistic territory, but they're not suicidal anymore. And finally, on the good news side, there's a credit boom in Turkey. As you may recall, Turkish Central Bank is among the 51 central banks which cut interest rates last year. Thank you, Fed. Thank you, Mr. Powell. You are doing wonders for Turkish economy. And when central bank cuts, it doesn't cut by 10 basis points or 25 basis points. It has so far cut cumulatively 1,300 basis points. That is, it has cut the policy rate by 13 percentage points. Of course, unless the economy is completely dead, that kind of monetary stimulus does make an effect, and indeed it did. Banks have rapidly matched central bank rate cuts with rate cuts in their loans, and as a result, we have seen a huge boom in consumer credits. You will see it in the chart below, and some improvement in corporate credit, though I wouldn't call it a boom. I think corporates are still extremely reluctant to leverage. They are deleveraging. That's the good news. I think fourth quarter GDP data on an annual basis will show a growth rate of 4 or 5%, but That's not the way Americans or the Europeans measure economy. I think on a quarterly basis, that is quarter to quarter, we'll see a growth rate over 1%. Now, the bad part is that this is not organic. It's not driven by the animal spirits of the business people or by the households. It's driven by state stimulus, which is unprecedented. I already mentioned central bank rate cuts. Obviously, if inflation is declining, central banks will cut rates. But as I will tell you in a few minutes, that's not so much the case in Turkey. Secondly, unless a country suffers from deflation, central banks are extremely cautious about cutting rates to negative real rate territory. In Turkey, rates, deposit rates, bond rates, policy rates are all in negative territory in real terms compared to current, that is ongoing inflation, and almost zero compared to 1 year inflation expectations. Obviously, that is harmful in the sense that it distorts resource allocation in the economy, forces people to put their assets outside the financial system, and reduces confidence in Turkish lira. The fiscal side is another nightmare. Turkish budget accounting should be punishable by prison because it reflects anything but the truth. For one thing, using any excuse, Turkish Treasury siphons off funds from the central bank, which is, yes, it is money printing and monetary financing of fiscal deficits. Over the last year, over the last 12 months, over 100 billion liras, or roughly $15 to $18 billion have been received from central bank, which has then been spent on the public. For 2020, it started very poorly. The January cash budget showed a tremendous surplus simply because they stole 40 billion liras from the central bank. Less the amount of money transferred from the central bank, the budget would have shown a deficit of roughly 20 billion liras or $3.5 billion. There is a tremendous reluctance to cut expenditures, and I and the economists I trust predict fiscal deficits to reach 5% of the GDP this year. Obviously, this brings in its wake a huge borrowing requirement, which increases debt to GDP ratio and interest rates, which crowds out private investment and borrowing. Also on the bad side is the fact that since there has been no structural reforms in Turkey, and since poor policy making and low educational skills of the labor force has led to a decline in Turkey's natural growth rate, even a slight pickup in growth leads to excesses or imbalances. And the primary imbalance that we're afraid of is, of course, the foreign trade deficit, which has started picking up once again. Over December and January, the cumulative trade deficit has reached $9 billion, which is financeable, but it shall probably accelerate in the next few months as businesses buy more inventory. And I don't think the oil prices will remain at current levels. More importantly, Turkish lira is fairly valued. And if the government continues to encourage banks to lend to consumers, they will start buying foreign cars and electronic appliances and software programs, or subscribe to Netflix, which are all actually imports. So import growth may accelerate. Whereas exports are stagnant, not because of our fault, but because our main trading partners, EU, are stagnating and Arab countries are not on a very friendly basis. So foreign trade deficits could become a problem in the sense that they could cause a weaker Turkish lira. I think the small spasm we experienced on Friday night is partly driven by the fact that Turkish corporates are paying ever increasing amounts of dollars abroad to buy inventories. The ugly part is inflation. January CPI printed at over 12% and over the consensus, and it's really not likely to decline. The ugly part is that, in each country, the statistics agency revises the consumption basket each year because people's consumption habits change. The Turkstat, our statistics agency, has done the same, but the new consumption basket is not reflective of the median Turkish citizen. It seems to have been designed not scientifically, but with an eye on minimizing inflation, in particular food inflation. I think it's not only my personal view, but a majority would tend to concur that Turkish CPI is probably underestimated by 2 or 3 points. So the underlying rate of inflation could be 15%. It is also ugly that the producer price inflation started accelerating. As I've said, producers have started buying from abroad again. If domestic demand continues to grow robustly, businesses will also mark up their profit margins since they have been losing money over the last 2 years, which would also prevent a decline in inflation. Finally, the Lira stability is largely a seraph, a dream. Even though Turkish lira against the dollar has moved very little over the last few months, this has largely been accomplished by state banks selling roughly $30 billion of foreign currency. So by foreign currency intervention. Obviously, this has to have an end. You can't do it when a country has a current account surplus. But this year, Turkey will have a current account deficit to the tune of $10 to $15 billion. And on top of that, Turkish corporates are reducing leverage. So using state money or central bank reserves to stabilize the currency will become very difficult. And there is a very strong correlation between the weakness of the lira and the rate of inflation. It's called the pass-through. So, in a reasonable future, Turkish lira will depreciate 10%, 12% against the dollar over the next 12 months. And that should add roughly 2 percentage points to the going rate of inflation. On the basis of this, I think Turkish inflation, as measured officially, will close the year at 12% or above. And the fact that deposit rates are way below that, roughly 10%, would mean that Turks would take their wealth out of the financial system, and Turks will prefer foreign currency deposits over Turkish lira, making it very difficult to conduct monetary policy. Okay, you have watched the Real Turkey channel. If you like these broadcasts, please send us your impressions in English, Turkish, or Hindu. I don't really care since I don't read them, but YouTube likes it. And do subscribe or share it with your friends. Atilla Yeşilada out.